Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, everyone, and thank you for tuning in to No More, Risk Better, a CreditSights podcast. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy. And today I'm very excited to be joined by my former boss and the former global head of macro strategy at Wells Fargo, Mike Schumacher. Mike, thanks so much for coming on No More, Risk Better.
Thanks, Zach. It's a pleasure. I'm just looking at your attire. I think maybe I should have gone to the Hawaiian shirt or something, but hey, this will be good.
Yeah, I'm
kind
representing
of break with my image.
I'm representing some Charlotte. We got some Charlotte logos here.
I like it. It's
I know,
a good look.
And you're coming to us from New York, right?
The Big Apple, home of the world champion New York Knicks. That's right.
All right. So for background, Mike was my boss for about 5 years at Wells. I was there from 2017 to 2022. So Mike, first and foremost, congratulations on the recent retirement. I understand your last day on the trading floor, at least, was June 17th, Kevin Warsh's first meeting as Fed chair. So a very fitting final day in the seat. And I think there's a lot that we can discuss in terms of Kevin Warsh and the new Fed. But first and foremost, how have you enjoyed the past 7 days or so after leaving the office for the final time?
Yeah, it's been a whirlwind. We had one day off, I guess, and hopped on a plane to California. Went out to see my dad for Father's Day. Got back last night, so hasn't really sunk in. Is the bottom line, but it's been an interesting vantage point just to start to decompress a little bit.
Yeah, that's great. So I want to start by, for any of our listeners that aren't familiar with your work, Mike, just having you take us through your career. I think you have a great perspective to share with us from a lot of vantage points in terms of the market today, but also having the perspective of looking back on a long career in Wall Street and maybe some of these bigger picture items that I think will be interesting. So maybe take us through where you started and how it all culminated in building out a global macro strategy team at Wells Fargo.
Yeah, thanks, Zach. So I started at a place, Smith Breeden Associates, back in the 80s, which was founded by one of my former profs, Doug Breeden, great guy, still active at Duke. Probably a number of your listeners have had classes by him or read his various articles and books. And Greg Smith, who was a marketing guy. And they had a small firm. They hired a bunch of us right out of school. So people who had some training and maybe a little too much confidence, but not a ton of experience. It was a phenomenal environment. It was great. We did a lot of work with banks, with thrifts, eventually managed money. And that was a really neat environment to be in, and certainly I learned a ton there. As time went on, though, I thought it was time to try something a little bit different, maybe a lot different. So I went to Wall Street, went to JP Morgan in the 90s, and actually 94. And not too long after I got there, the Fed started this nasty tightening cycle. So thank you, Alan Greenspan. You made my first 6 months on the sell side very eventful, and that was really off to the races at that point. So shifted gears, and I found that it was a different perch and interesting in lots of ways. I got to meet various types of clients, as you all can appreciate. So whether it was central banks, investment managers, insurance companies, hedge funds, you name it, and really got a good sense for the mix of investors out there. And later on, and I'll talk about that a bit with the perspective of Wells Fargo, but I got to meet a lot of corporate clients too. So that was neat as well, and I think really rounded out my sense of how the capital markets work. So I was at JP for a brief period. Then I went to Smith Barney, which became part of Citigroup. I was at Citigroup for, about a dozen years in various research capacities, and wound up running a good chunk of the U.S. research operation for fixed income. And after that, I said, well, maybe it's time to try a small firm again. So I went to not just one, but two. And I think a small firm can be a great experience, but a lot of things have to work out and line up nicely. And for me, I was missing some of that back and forth with the big clients that I'd grown to like so much. So I went to UBS in 2015, actually in 2010, and left UBS in 2015. And then you and I met up, Zach, a couple of years later at Wells Fargo. So the last 10 years have been at Wells. And again, it's been fascinating there in particular to speak with so many corporate clients, the investors as well, but the corporates were really fairly new to me. So I got to see how they operated and what their thought process was. So I think it really helped round me out.
Yeah, that's great, Mike. And so, starting on the sell side back in 1994 is some potentially interesting analogs to today that maybe we can kind of come back to. But given all of that experience on the trading floor, and I've spent a fair bit of time in my career there as well, do you have a favorite trading floor story? I'd imagine it was somewhat even more interesting back in the mid 90s than what I've experienced in the mid 2010s or early 2020s, whatever it may be. Do you have a favorite trading floor story for us, Mike?
There are quite a few. I'll give you one really just sort of a sea change moment for me. So again, I was at Smith Barney, which was a place that I thought punched above its weight, but it was not a top tier player. And what happened is Travelers bought Salomon Brothers, which was absolutely a top tier player and very big in the bond market, probably the biggest. So a few Smith Barney fixed income people that stayed around were merged into Salomon. And I remember the first U.S. non-farm payrolls day that I was on the Salomon trading floor. I think the volume had to be, I'm talking noise, not trading volume, must have been 10 times as loud as Smith Barney. The amount of yelling, screaming, and I thought, wow, this is a very new experience. It was incredible. So it was really phenomenal to see just how much risk clients moved around quickly. Now that they clearly stood out, really just in contrast to my previous experience, but also going on, it was amazing to see just a big machine like that in action. So I'd say as far as a demarcation point, that would be it. So I'll put that up there as one of my favorite stories for sure.
That's a great one. And so was the reaction to the number itself or just the amount of trading and activity after the fact?
It was really the whole platform, the whole team got so fired up about this number. They knew there'd be a lot of activity, a lot of trading, hopefully a decent amount of money making involved as well. Everyone was amped up and it was just a big release. And you could say, well, that would be true at other firms as well, I guess, but it was just a much bigger event there because Salomon Brothers at that time was so big in the bond market and it had such a dominant perch that they could say, hey, we're really going to make this a big day and our clients will benefit. And people were just so fired up. And successive non-farm payroll days were like that, I suppose, but that one was such a contrast for me that it stands out.
Yeah, it's a pretty wild environment to be part of. And thinking back, my limited knowledge of Salomon Brothers, I think they were the number one bond trading house on the street for quite some time.
That's right.
So I can only imagine the amount of P&L associated with a large volume day like that, especially back then with a little bit less regulation on bid-ask spreads and various
more balance sheet too. A lot more balance sheet capacity.
Yeah, that's probably even more important. All right, so maybe conversely to that, where were you when Lehman filed for bankruptcy in September 2008?
Yeah, I had left Citigroup. I was at a small firm, and I felt like I was on the outside looking in. And thankfully, Zach, that was a good place to be.
Yeah.
And I remember going home several days in September, October 2008, that time frame, and telling my wife, Joyce, I said, look, if things go badly tomorrow, you can just forget about recession. We're going right to depression. So I was at the small shop and the Lehman announcement came out and everyone was stunned and the markets they imploded. It was really interesting too, because if you think about that timeline, Bear Stearns went bust in March of 2008. And from the Bear Stearns to the Lehman event, I think the S&P was only down 3 or 4%. Now, sure, it had some bumps in the road, but it was really pretty steady. So it was almost this long, eerie, quiet period. And that ended abruptly. And I remember the day that the TARP vote happened the first time, and it didn't pass. And it went down 10%. The Dow did. S&P probably as well. And Congress said, well, it's time for a do-over. That clearly was not the right answer. Let's try again. And 4 or 5 days later, it passed. And I'd say that was the start of the recovery process, but it was a good 4 to 5 months later until the market really found its footing. So that was an extraordinary time. I will tell you, though, if you think through, everyone rightly latches on to the financial crisis and says that was a massive event. But I think that for me, I started to see signs that my worldview probably wasn't quite right when long-term capital blew up in 98, because really when I started out in the markets, I thought markets are about who's got the better mousetrap. So who's the better analyst, who's a little more quantitative, that kind of thing. And those firms or those people will win. And that was sort of true for the first 10 plus years of my career. But long term, I'd say per capita had the most brain power of any firm I've encountered. 2 Nobel Prize winners, all sorts of very high power traders, and they still blew up. So that's when I started to think that markets were about something a bit more than just who had the better mousetrap. It's all these different players sitting around the table with various incentives. It's sort of like a poker game. You've got to understand how the banks move and what drives them, and why an insurance company's got a different incentive to hold for the long term, how a hedge fund might come into play, and therefore what it means to run leverage that might be a little bit too high. What happens if that becomes the case and you can't get out? But these things weren't really very apparent to me until 98. And then they became super clear, I think, to me as well, but also the market broadly 10 years later when Lehman imploded and it was just a complete meltdown.
I think that's really interesting perspective. And I'm actually reading The Ascent of Money right now by Neil Ferguson, and it goes through the long-term capital management episode. And right now I'm kind of reading about the financial crisis and how central banks responded, and just discussing how the TARP vote went down. And that was, a huge market mover in terms of that first vote not passing. And I feel like for me, I started my career on Wall Street in economics research in 2012. And so I've kind of always had the benefit of hindsight in thinking how could so many people have missed what was going on in terms of these kind of bad mortgages being in CDOs and things like that. For you, Mike, when you kind of highlight long-term capital management and thinking about all of these extremely smart people, and I've kind of gone back and read on this a little bit, but seemingly their models just didn't have any historical data to capture what eventually ensued in the late 90s, and we won't get into that into too much detail. But I guess, what to you, looking back, leading into the financial crisis, was kind of the most overlooked perspective? I'm admittedly, I'm not sure what you would have been covering around that time. Obviously, we did rates or macro together, but kind of how do you think that was able to transpire? With the recent passing of Alan Greenspan, some people kind of blame easy money for too long or too little regulation. What's your perspective on that? I feel like that's certainly an interesting time frame to reconsider.
Yeah. So leading up to 2008, I left Citigroup in June of that year, and my team at that point was responsible for global rates, some EM, and also MBS. And credit. I had a decent seat looking at that situation. I think it was incredibly complex. I'd say the single biggest thing that people missed was so many linkages to the U.S. housing market. You had firms everywhere, investors buying securities linked to U.S. housing. So mortgage-backed securities clearly, and ABS, but it was deep. And one of the first indications that I saw that there was trouble is a Canadian money market fund invested in something called ABF, I think it was. We didn't really know what it was. Had to look it up and thought, well, if we don't know what this is exactly, why is this fund in it? That's probably not a good sign. And that was in 2007. But the mortgage market is so deep in the U.S. That's a positive thing, but also there's so many incentives for investors to be involved in mortgages. For instance, and this is kind of wonky and geeky, but banks and savings and loans get an exception to the loans to one borrower rule for Fannie and Freddie securities. So they can own a lot of them, basically. So of course they did. And when you think about the way the capital is treated for broker dealers, they also get very beneficial treatment for owning those types of securities, Fannie Mae and Freddie Mac. Ginnie Mae, of course, is full faith and credit. But if you think about the backdrop, where you've got mortgage-backed securities held by investors throughout the U.S. financial system, but also probably at least as important, held in very large size globally, you can say the stage was set. And then really what needed to happen to spark that fire was a housing, not even a meltdown, but a drop, which eventually morphed into a meltdown. And if you think about the role of Fannie Mae and Freddie Mac, they were set up to provide liquidity to the mortgage market. So if you're essentially a mortgage or a housing guarantor and the housing market has a downdraft, you're going to lose money and your securities are going to be questioned. So it really was I think all the linkages that people missed. And it was certainly, I'm guilty of this. I'd say the policymakers, virtually everybody, I think, who was involved underestimated just how widespread the influence was of the U.S. mortgage market. So it was incredible. It was incredible to watch it unfold and to watch all the implications too. I remember watching the home builder stocks take big hits, and anything at least loosely related to housing just really got pounded. But it was all that the ties that people had and investors had to the housing market, to mortgage-backed securities. And it was very tough to measure those things. And I suspect it still is, actually.
Yeah, one of the things that sticks out to me is the incentives as you discuss when we think about back then, banks could make the mortgages and they then sell off the exposure. And I think some of those linkages, the incentives to generate fee revenue and then transfer the risk. And it just seemed like there was appetite to continue transferring risk and perhaps a lack of attention in tracking where it goes. But really where I want to go with this is thinking about how different investors are incentivized, how they have different parameters. The banks are huge institutional investors, but have extremely large capital rules and other regulatory frameworks that they have to abide by. When you think about what moves the market, let's say the US rates market or the treasury market, obviously being one of the largest and deepest in the world, how do you think about the fundamentals and the role they play, economic growth, inflation, things like that, and really more of as we say in credit, kind of the technicals in terms of just the flows of money and some of those incentives? How do you sort of balance those two factors in terms of how you weight what really drives where rates are going next, for example?
Yeah, it's a huge question. I would say the fundamentals will dominate eventually, but it can be a while. So flows can overwhelm fundamental factors for weeks, maybe longer. And it becomes frustrating for people in the markets because they might look at a series of relatively hot inflation prints or strong growth or whatever it might be and say, well, clearly this should have X effect. And it just doesn't. And the question is why? Because a group of investors somewhere are shifting their risk positions and they're big enough to really overwhelm that fundamental effect. It sounds obvious, but it's hard to measure. That's the thing. And I think sometimes people fall back on talking about flows as a cause of market moves, and it's to some degree a default. Not exactly sure what's driven the markets, but they look at the fundamental factors and say the market moves don't line up, so therefore it must be flows. There's probably some of that, but I think it's a pretty valid point that these flows can be really important. And I think it's interesting too, Zach, to tie in a comment or maybe a view that Kevin Warsh talked about last week. And his basic take was he thinks markets do best, that is, they're most efficient, when people in the markets are looking at and responding directly to the data, instead of looking at the data and trying to figure out how the Fed is going to respond or how the ECB or some other central bank. So he wants investors and funders to look more directly at that economic data. And to me, that means more of a tilt toward fundamentals. So I'm not sure how you or I would categorize the Fed reaction function or another central bank reaction function. It's not exactly a technical thing, but it's not a fundamental. It's this other issue out there. But he wants to get away from that too. So more of a skew toward fundamentals, which in my view would be healthy. I think that's a good thing.
I agree. That was one of the things that resonated with me. I feel like this is something that we would talk about explicitly in terms of, it may not matter what you think, you actually have to get in the head of the Fed policymakers. And that feels like adding an
Another
sort of a
layer, right?
derivative.
Yeah,
Yeah.
I agree. You got a bunch of people around the table, and maybe one has had some spicy food and reacts differently than you think. I mean, it's hard to figure out these things. So yeah, adding that derivative factor is probably not super healthy. But when you think about the way that markets have behaved, really since 2008, the central banks have been so big. And it's not just that they've had rate policies move around quite a bit, but think about the role of quantitative easing and big balance sheets, probably here to stay. That was not the case prior to 2008. So central banks are much bigger players in markets now than they were 20 years ago, for sure. There's no question. So I agree that derivative factor is out there. I don't think it's especially healthy, but it's hard to get rid of it entirely. I can't see that happening.
I agree. And I'm glad you brought up the balance sheet because that's one thing that Kevin Warsh has historically been extremely vocal about. And I'd love to get your perspective on how likely it is for the Fed to shrink its balance sheet at all in the near term. And is there any possibility that we go back to a pre-2008 framework where scarce reserves are used to influence or implement monetary policy?
I think it's very unlikely. The ample reserve system has been in place for quite a while. Banks have adapted to it. That would be a massive change. Seems like a big risk for the Fed. We know what Kevin Warsh's basic view is on the balance sheet. He's made that clear for many years. What can he actually do today? I'd say near term, probably not a heck of a lot. He can reduce T-bill purchases, but they've already been cut, so that's just on the margin. I suspect his bigger hope is by continuing to deregulate, the banks will have lower need for reserves. So in time, that could mean the balance sheet shrinks, let's say as a percentage of GDP or some sort of measure like that. But that's a pretty slow process. The idea of taking it down quickly from 6.5 trillion to 4.5, that just seems far-fetched. And I can't believe he really views that as too likely either.
Yeah, that's the conclusion we came to. It really all comes down to the regulatory side, and that's how you can influence one of the Fed's liabilities, reserves, and actually bring that lower. But thinking about the Treasury General Account and currency in circulation that simply rises with the growth in the economy, more or less, shrinking the balance sheet dramatically is kind of a difficult process to consider.
Absolutely.
So one thing that keeps coming up as I kind of go through the markets today and think about where we're headed from here is just how resilient capital markets have been in the face of, let's say, Liberation Day last year or a dramatic shift in tariff policy and more recently the Iran war and the energy shock implications of that. And I'd say the chaotic nature of supposed changes in that situation. And to me, it seems like markets generally have become far more resilient. And I would say post-COVID is kind of my time frame relative to when we were working together at Wells in, say, the late 2010s. It seemed like, one thing that I always go back to in my head, it's kind of random, but North Korea would be shooting off missiles in, I think it was 2017 or 2018, and that would move the treasury market fairly substantially, even though the implications, the practical implications of that were fairly limited, and we'd be talking about it in traders meetings at that time. Now you have much more muted market reactions to much larger geopolitical events, I'd say. Do you agree with that assessment? And what do you think the main driver of that is?
I definitely agree. That's been quite telling, I think, over the last 4 to 5 years. I think back first to the Russian invasion of Ukraine And that moved markets a lot for maybe 2 weeks. And by the end of a month, it was not every single price was back to where it had been, but by and large, markets had moved past that conflict, which is incredible. And then when you think about the Iran war, it's been going on for what, just about 4 months. And there was a ton of movement right away. And the rates markets have still been quite upset, but equities have just sailed on their merry way. Credit has done very well. Spreads are probably tighter now, or as tight as they were before the conflict. Volatilities are quite low. They've come back quite a way. So question is, why is that happening? There's a tremendous amount of cash sloshing around the system, and I think that's part of the explanation. So U.S. money market balances must be 8 trillion-ish. So that needs to be deployed. That's just one measure. I know it's only U.S., but still. And on top of that, we've had this AI boom just go bonkers. So that's driven a risk too. So I think certain pockets of the markets have gone just almost vertical. But when you look at the rate markets, people have taken a different view. Now, it might just be because people in the bond market are fundamentally not super optimistic, but when you think about the amount of issuance that was coming out already from sovereigns and the number of countries that talked about boosting defense spending prior to the Iran war, well, that number has to go up, and the numbers have to be much larger now than they were. So a lot more sovereign debt issuance. And then in addition to that, a lot of the CapEx out there is being funded by debt issuance. And the hyperscalers, as you know better than I do, Zach, they've been tapping markets across the globe. So doing issuance, not just in dollars, but euros, Swiss francs, you name it. So that continues. And to some degree, that's a substitute for sovereign debt because by and large, these companies are highly rated. So there's a lot of supply out there. And I think people are worried about trying to absorb that.
Yeah, I think it's been very interesting to us doing the analysis of how markets have moved since the start of the war, comparing it to the Russia-Ukraine invasion in 2022. And to your point, yeah, the recovery was very quick. Even in 2022, it's been less so this time around on the government bond front, to your point, Mike, with all of this supply. And I think there's a lot to unpack there. One of the things that we've been tracking is just how closely treasuries have been trading with equities when you think of government bonds typically being a hedge for risk assets like equities. So, I mean, do you think that what we've seen in terms of higher correlations, positive correlations between the prices of treasuries and equities, is that more attributable to the war and kind of short term, or do you think it's more of a structural shift where markets, financial market participants in general, are more concerned about debt levels in developed countries? And so treasuries and other high quality government bonds may, on a sustained basis, act like less of a ballast for portfolios going forward.
Yeah, the correlations tend not to be super stable, I'd say, over a couple of years, but somewhat reliable longer term. I would say if we do a conversation like this, let's say in a year, I think you're going to see correlations that are much more what we would call normal. So equities do badly, bonds rally, that type of thing. But for now, people in the bond market are trying to wrestle with all these issues coming up, whether it's more supply, inflation that's still running hot, central banks that broadly speaking went from being priced to ease a fair amount in the Fed's case to being priced to hike. The ECB actually did hike and more to follow, I think. That's been a lot for bond markets to take in. So I think given another 6 to 12 months, we probably get past that and those correlations start to look a lot more normal, but it could be a pretty rocky road. And right now, I love your comment about ballast. You'd say, well, if you're running a big diversified portfolio, where would the ballast be? Well, it hasn't been bonds. It hasn't been gold. So the traditional backstops really haven't worked well. And it's pretty interesting to try to think about what the next one might be. It's also interesting to focus on the huge rally by the US dollar over the last couple of months. A lot of people would not have guessed that, and yet it's been a stalwart.
Yeah, it's interesting what takes the place of treasuries in terms of providing that, and in some of the crazy market moves we've seen more recently. I think it's it's pretty unclear. It's been a little bit surprising to us in terms of credit spreads remaining extremely tight, but in terms of the client meetings that we've been having, there's been a lot more focus on overall yield levels that you're getting on high quality corporate credit, which look historically much more attractive than the spread component, which is basically at the tightest end of the range going back to the late 90s. So it does seem like there is demand at these yield levels, especially for high quality corporate credit. And when you think about where we are today, 10-year treasury yield, call it 4.5%. Do you think we are more likely to hit 5% or 4% next? And one of the things that I feel like we didn't talk about as explicitly, sort of in the rates world, is that potential for a ton of demand at a certain yield level from just kind of a total return perspective as we're trying to consider some of the more tactical moves. But do you think, can we go back to 5%? Can we go above it? Or do you think it's more likely we're headed back to 4% given sort of what we know today?
I think five's in play. If I had to choose 5 or 4, I'd go for 5, not by a lot. And look at the market. It's sort of a coin toss, I guess. And where I come down thinking about that is inflation is still running hot in country after country. The Iran deal, I'm not even sure what it means exactly, and I doubt that's going to end the conflict anytime soon. So that means a more prolonged period of relatively, well, very disrupted flows coming out of the Strait. So probably a longer period of high inflation. And to me, that means central banks get a bit more hawkish, and that probably pushes up rates across the curve. I understand that the 10-year is not going to move as much as a 2-year. If the Fed hikes, that's clear. But still, when you think about the overall pressure, I think we're in for a round of rate hikes by a number of central banks. The Fed does not want to hike. The Fed, which I think is the right call, would love to just watch the data come in for a while and make a decision. But if the data do continue to run hot, let's say for 3 to 4 months, it'll have to do something. So I can imagine a case where you get 5% plus. I have a tough time seeing 6% in the next, call it 6 to 9 months. That would take something really bad. And as far as getting to 4, I think that's a pretty straightforward call. There actually is a wind down to this conflict, and people can see a path to oil prices, which fall pretty quickly, pulling down inflation. Central banks don't get as worried about all that and shift from their tightening bias. So I don't have any problem with that narrative. It just seems less likely to me than the 5% story at this point.
So I'm glad you brought up the 2-year part of the curve, obviously more sensitive to changes in policy rates or really changes in policy rate expectations. And the curve has flattened a ton in even just the past week or two, but over the course of this year, I think the peak is 73 basis points year to date on the 2s 10s curve. We've fallen to around 27 basis points at the low, which is probably right around where we are today. And Winnie and I were talking about this yesterday. When you see a dramatic flattening, and maybe when you flatten to the levels we're at today, is when you start to get questions about curve inversion. And if you get curve inversion, you of course get the recession indicator conversation. So when you think about how the market has repriced so far, obviously going from rate cuts to rate hikes, but considering what's driving that repricing, do you think curve inversion is likely? Or perhaps I should ask it this way: what do you think is more likely to happen next? Do we go to, call it 100 basis points on the 2s 10s curve, or do we invert first?
Wow.
100's steep. 100's kind of steep from where we are today. But
I have 75. How about 75?
Yeah. We can go with 75.
Inverse auction or something. Yeah, I'll take 75. Done. Sold to you. Sold to the man in the blue and white shirt. Yes.
75 is done?
I think so. Inversions are tough, and markets respond badly. And you do get all these comments and questions about, does it mean a recession's imminent? I'd say it's not a great indicator anymore, but still there'd be a lot of concern. But that aside, I think about what sort of backdrop would you need for an inverted curve? Well, probably a lot more inflation and a very low beta, if you want to call it that, for the 10-year to expectations out of the Fed. That seems unlikely. I don't think that beta is going to drop a lot. So I look at it and think that if you get the Fed repricing, let's say for the next 6 to 12 months by 25 basis points, it's probably worth 20 basis points in the 2-year and 10 to maybe 15 in the 10-year. That differential would have to move a huge amount. So I'm skeptical that happens. That would take a lot, but can't discount it entirely. Again, I can imagine a case where I'm too optimistic and the price of oil just goes really wild and WTI goes to call it 150 for a month or two. That probably would drive an inversion, but I think it needs to be something really grim like that. So I'm going to take 75. Done.
I think that's fair, especially when you consider just how strong earnings have been in the first quarter, and that's kind of wrapped up. I'd say
great.
economic activity has been great. So this repricing of the Fed and rates is not purely a, call it, negative story with respect to just being inflation driven, inflation fear driven. And so to the extent you have economic surprises coming to the upside and that pushing rates higher, that's not something you'd typically associate with a curve inversion type environment.
Yeah, higher rates for a good reason. Activity is strong, earnings are good. Those are certainly very legitimate things, and that's, to some degree, we've had that.
Yeah. Well, speaking of higher rates potentially for a good reason, we haven't really talked about AI much, so I'd like to get at least some of your perspective on that. Maybe how you think it could change the world of research, having been in research for quite some time in your career, but also what is your initial read on how that's going to impact, whether you want to think about it as the natural rate of interest or sort of the 10-year Treasury fair value, any way you'd want to consider the broader and longer term impact of AI and interest rates. I'd love to get your thoughts there.
Yeah, so let me reframe that a little bit. Let's think about the AI impact on inflation. And I think it's very time dependent. So for now, you can see the massive demand by the hyperscalers as they build data centers. They want to hire every welder in Louisiana, it seems, for Meta. And every cement truck probably in the Western US has been occupied, that kind of thing. That's true in other countries too, not as much, but still. So that surge goes on a while. I would guess that's probably a year or two, something like that. Most people I've read and talked to seem to think that the CapEx will spike out or will peak in the next year or two. So done by the end of 28. So maybe that's a 12 to 24 month pickup in inflation. After that, I suspect it becomes disinflationary. So there's kind of a transitional point, and then you get more of a benign effect. Productivity goes up a lot. I think that's pretty clear. Technology almost always does that. The question is how much this amazing, really humongous technological advance does boost productivity. And it's a hard thing to measure. It could be 0.5% a year. It could be higher for a while. It's tough to tell. A lot of the numbers that came out around the internet boom in the late 90s and early 2000s had productivity up north of 1% for several years. So that seems like a low bar for something like AI. I think it could be even bigger. So inflationary for a while and then disinflationary, but it's really incredible to think about that path. Now, your other question about the role of, and I would broaden it, AI on research and investing. I think AI is amazing for macro people because what AI is great at is you say, this is my view. Now go come up with 3 or 4 ways to express it. So if I have some macro thesis, I think inflation is going to be hot in the US for the next 2 years, hotter than the market expects. I can tell some AI model to go figure out a way to express that in tips or inflation swaps, a way to do it in some other sort of bond market form. Maybe there's an options trade. It can think of more variations than I can and come back really quickly. And then we can iterate. So I think it's really good at that. What it strikes me it's not terribly good at is if I've got sort of a bottoms up approach and I say, all right, I think these things market wise are out of line, whether it's in equities or bonds or whatever. How should I position a portfolio overall? Or should I take more or less risk than usual? AI will come up with an answer, but would I be confident in that answer? No. So for me, I think it's good for macro people. I think it'll give them a lot more ideas or a lot more implementations pretty quickly. And I think it's not that great for the bottoms up folks.
I think that's a great distinction in terms of probably not perhaps being able to come up with big picture theses, but being able to say, here's my view, how do I express it? And I think that just highlights how important people will remain in the investing and research process, but how much AI can enhance your ability to perhaps express a view as whether it be capital efficiency or greatest risk return profile, whatever it may be, AI gives you the ability to pull that out quickly, more easily than we could kind of just running the analysis on our own.
Oh, definitely. It is phenomenal, Zach. And I think that personally, I've just scratched the surface. I plan to look at it a lot more intently. And I'm not sure how far down that path you are, but the capabilities are really amazing. They're astounding.
It really is. And actually, to that, Mike, one of the things I wanted to ask you, thinking about, so you've seen some changes in financial markets over the course of your career, some major cycles. What's the best personal investment you've ever made over the course of your career, obviously being in the markets for such a long time? And I'm going to have to ask the inverse of this question as well.
Yeah. Okay. So the best one in terms of return, not in terms of dollars, but percentage return, was XM satellite radio. Now, I bought this in 2008, right at the peak of the crisis. And I think I just had a little extra cash in my pocket one day. So I didn't put very much into it. I bought it for 12 cents a share and it went down to 6 or something almost immediately. And I thought, oh, well, that was a lottery ticket. It didn't work out. But then it rallied and it rallied and it rallied, and I sold it for about $6. So that was 50x. But don't get too excited. The amount of money I made on that was pretty small. It was gratifying that it was a big percentage, but I kicked myself for not being a lot more aggressive. So, and I bought that for the wrong reason. I just liked the service and it happened to work out. But
50x is nothing 50x. To sneeze at, Mike.
Oh, no, that was, well, again, if the dollar's involved and had a couple more zeros, we'd be having a different conversation.
That's for sure.
Oh, well, what can you do?
All right. So the other end, what's the worst one?
Yeah, well, so I think one problem with people who've got kind of a quantitative bent is they tend to think things should move faster than they do. So during the internet boom, I thought, well, some of these valuations look pretty crazy. And if I look at two businesses that do basically the same thing, and the PE difference is probably a factor of 3, one trades at 30 and one at 10, surely I should buy the one trading at 10, not the one at 30. So I put on a pairs trade, buying Barnes & Noble against Amazon. That didn't work out well. So
that's a very funny one, given where we are today.
If you want to short a stock, buy puts. And don't think about your model too much when you've got just a massive shift. And I think that sort of ties to the AI discussion we're having too. I mean, I look at some of the AI valuations, and probably you do too, and a lot of the viewers, and think they're just out of control. Well, they might be, but if it's a world-changing technology, you need to just factor that in a huge way. Don't undersell it.
Yeah, well, you can't have a conversation about valuation right now without bringing up SpaceX. And I mean, that's coming back down to earth. I mean, it's not really coming down to earth, but it's coming back from crazy peak levels. Do you have any exposure there, and any thoughts on SpaceX?
No exposure there. I think it is incredible, though, to consider just the monster market cap so quickly. And Elon Musk, the guy, certainly, he's about as creative as it gets. Say what you will about his political views and other things. He's built 2 companies from the ground up. It's really incredible.
Yeah, it seems like if anyone can make good on these promises or goals that they have, you'd have to imagine he's about as likely as anyone we have on Earth right now. But in terms of the stock, going back to a random walk down Wall Street, I think the phrase in there is castle in the air. It seems like SpaceX is the castle in outer space, or castle on Mars, whatever it may be. But kind of to your point, just because it's got the highest multiple doesn't mean that it's kind of an obvious short, especially
No.
when we're considering some of the technological advances and potential for data centers in outer space, whatever it may be.
Yeah. How do you put a price on the wow factor? They've got rockets coming back and landing and being picked up by essentially chopsticks. It's just mind blowing. What's
It's
that worth? That's worth a lot of PE.
that's definitely worth a lot. So one other perspective of yours I want to get, Mike, it kind of strikes me that, when I was first talking to you and interviewing for rate strategy, there was a lot of focus on kind of being quantitative in terms of your analysis, statistical in nature, and that's, I think, an advantage in research. Really, any number of perspectives you can bring to analyzing the market is only going to give you a better chance to forecast better, recommend trades better. It seems like now perhaps that is having ability and knowledge of AI, whether that be knowing how to use the prompts, knowing how to incorporate it into your analysis. But sort of with that backdrop, for any of our listeners that may be new in their careers and kind of starting out on Wall Street, whether it been in research or another line of business, what's kind of your biggest piece of advice you think would be worth sharing after your years of experience?
Yeah. I think that having a good quantitative background is great. And I think that's a really good base, but it's not the whole story. So we talked about my awakening around long-term capital, and that was part of it. But I think it's really dawned on me clearly that it's the behavioral factor that drives markets. You've got all sorts of players out there, ranging from investors to issuers to politicians to central bankers, regulators, you name it, tons. And they all have different motivations, different objectives, constraints, and they're going to interact in ways that impact the markets. You need to understand as much about them and their motivations as you can, because that can overwhelm any model. Donald Trump's a good example. So the president tweets all the time, or whatever they're called now. So we know that, we become acclimated to it. But at first people were just shocked, thought, well, surely he'll stop. And well, he hasn't. He's actually, I'd say, increased the pace. So no investor right now would ignore the Trump factor. And I think that becomes a concern. Here's an example. So the USMCA, something has to happen by next week. There's a deadline. And Trump's been talking about tearing up the deal, which a lot of people expect, but who knows what he might say on the eve of July 1st. He might have some wild tweet on June 30th that totally disrupts anything related to U.S.-Canada trade, and therefore Canadian stocks or U.S. bonds or who knows what do something and the currency goes wild. That could all happen. So you've got to understand that big player. You need to understand, we talked about the reaction functions of the central banks. They're not that clear cut. They may not be super complicated, but they're not obvious. You don't get the glimpse inside the curtain. So it's understanding the human aspects. And I think it's also worth noting, if you look at the Nobel Prizes, for instance, over the last 20 plus years in economics, a lot of those have gone to people doing behavioral work. Whereas if you think back years ago, it was people like Myron Scholes and Bob Merton getting a Nobel for option pricing. Well, that you haven't seen a prize like that in a while. It's been much more the human interaction element. So I'd say focus on the behavioral parts of markets as much as possible. I think that really is a key part of it that people tend to overlook.
Well, I'm glad you went there, Mike, because I wanted to get your perspective. Maybe you just really shared it, but in terms of client meetings and in your career, getting to travel across the world, visit institutional clients, probably in a very large number of countries. I know that you certainly hit many continents when we worked together. How would you rank your greatest meeting or set of meetings or even client event, whatever it may be, person-to-person interaction relative to what you'd consider to be the best analysis you've put together in terms of what was most valuable for your research product?
It's an interesting question. I think that, so which one was more impactful maybe? You can see the impact of a series of good meetings or a good conference pretty quickly. It's harder to tell right away the impact of a good research piece. Yes, if there's a specific trade recommendation and a bunch of clients trade on it, great. But as far as a longer term impact, that's tough to measure. So I think about some of the research pieces or strategy publications that I've put out and others have put out, and they can be a lot of fun, but it's just tough to measure how they actually hit the bottom line sometimes. So I like to look at them as door openers to some degree and really help people get invited to go talk to the clients or have the client call with a question. I think that's a great way to really to break the ice. Client might say, "Oh, Zach, you wrote this interesting piece on some particular type of IG. I was thinking about it differently. Could you take me through it?" That's a great thing. So is there direct revenue there? It's not clear cut, but is there indirect? Yeah, I think so. So to me, that's a lot of fun. But as far as the most productive meetings, I've gone to a ton of conferences, as you have too. They're usually good. They can be pretty effective. I remember going on one trip to Asia, and we missed the first day of the trip. There was some sort of bad storm in New York. Flights were canceled. Decided to go anyway. And something like 11 of the 12 clients we still saw did trades within the next 4 or 5 days. And it was a pretty large number as far as P&L. That's a good thing. That's not to say we only want to go see clients to print big trades, but it just showed there was a good back and forth. And certainly it feels good to get on a plane and think that you've actually hit the bottom line. That's a nice thing. But I guess what I value the most out of the clients' conversations over the years is you want to be a long-term advisor. So it's not about a trade or 2 or 3 trades. It's talking to somebody over the years and building up a lot of confidence both ways. And when the client's got a tough problem, then hopefully that client calls you. And that's what you want. To me, that's the ultimate goal.
Yeah, I agree 100%. And I do think obviously it's very rewarding when those trades come in and there's obviously P&L associated with that. One question I want to ask, because there's one that comes to my mind for me personally, but what was the most challenging client meeting you ever had? I would imagine going back in your career, maybe earlier on, it could have been one of those. I can recall one where we were meeting with a client and he just wasn't liking what we had to say, and he made sure we sat in that room uncomfortably for a period of time. I think I may have sweat through my suit jacket on that one. I won't share any details, but
Yeah.
do you have any, is there any one that sticks out to you where really your message wasn't resonating and the client wasn't kind of letting you get off easy on it?
Oh yeah, there are a bunch of those, especially in some cases they were just parts of a meeting, and others they went on the whole meeting, which is never good. But in some cases you just don't connect personally, and maybe, who knows, the client is having a tough day or just doesn't like the way the presentation goes or had a different sense for what I might bring or you might bring, and it's just not, those 2 trains don't meet up at all. So I've had a number of those, and I agree. I've sweat through my suit a few times. I've had
I
a
feel like
couple
you have to
clients
have that experience.
just call me
though.
out and say, "Come on, you got to have an opinion on that, please. Let's have it."
Right.
Got an
Right.
opinion, don't have much confidence in it, but here it is. I've had a couple of cases where the clients just, one case I recall, not going to name the client who I get along with well now, but he just had to vent for about 10 or 15 minutes. You weren't there, Zach, which is probably just as well, but he yelled at me and the salesperson for quite a while, and then everything was fine. So it was out of his system and it was all good. And there are some where it's just a one-way discussion, and those are really tough. So you get pelted with questions for a better part of an hour and really think, oh, I've got a few bruises after that one. But it's all part of the deal. It's okay.
It is. I think you got to have those experiences. And I think it sounds like in that one situation, you're probably that much closer with the client for having had that experience.
Yeah, I think that's right. Now,
Well, one
I
more
can say
on
that. Looking back, wasn't good then.
right. What's your favorite client event you did? I know we had some great ones at Wells. I'm sure you've had plenty of great ones over the course of your career. Does one in particular stick out?
So back in a more decadent period, about 25 years ago, I worked at Citigroup, and we had a bunch of us and some issuers, and we wanted to go see clients across Europe. And the sales manager was pretty good at logistics, and he figured out if we rented private jets, we could see more clients in more cities. So sure enough, he rented a series of jets. We went to, I think it was 9 cities in 5 days. It's the only time in my life I felt like a rock star. So you'd fly into the airport, the car would come out to meet you. It was great. So
Wow.
can't do that now, but it was tremendous. We'd go to the meeting, do our thing, hop in the plane, sit in the back, play cards, might have been an adult beverage, and then go on to the next city. Can't beat that. So again, that was a long time ago, but that was quite a thing.
That's a different era. So would you be doing multiple cities in a day, it sounds like?
Yeah, we'd hit 2 a day most days. So you name it, pretty much any European financial center we covered over the span of a week.
Wow.
And we're very exhausted and everybody went home. But yeah, you couldn't do it with commercial aviation. So I understand his point. But
Right.
But the idea of trying to get that through any sort of big bank's expense system now and get that authorized, not going to happen.
No way.
No.
Well, that's a great story potentially to end on, but I think we kind of got through a lot of what I wanted to ask you about, Mike. Frankly, I feel like we could talk for a few more hours and I would find it very interesting. But is there anything in today's market or anything kind of reflecting on your career that we didn't cover that you think is interesting or worth highlighting to our listeners?
Well, I think that perseverance is a big thing. And Zach, you can understand this. You're a Buffalo Bills fan. They've lost 4 Super Bowls. I'm a Minnesota Vikings fan. They've lost 4, although not in a row, but still. That's a couple of long droughts. So I think if you can sort of power through that and still keep that flame of hope alive that maybe one day they'll actually get it done, that preps you for a career working in the bond markets too, because you can think, hey, I've made some good calls, some bad calls, but maybe the next good one's right around the corner. So it seems to me that sports fans' perspective is probably helping out both of us right now.
I like that. Perseverance, and while hope is not a strategy, you gotta hang on to it.
That's right.
And so what's next, Mike? And over the next couple of weeks, couple of months, any travel plans? What's on the immediate docket?
Yeah, near term, it's basically kind of a sugar high, I guess. So extended vacation, people on the call have been gardening leave. They all get that idea. So yeah, a decent number of trips, some families, some others. We're going to Iceland, I guess, in 3 or 4 weeks. South Africa the month after that, so end of August. So I'm sure we'll weave in some other good travel too. And down the road, think about what really the next steps will be. But I think, Zach, that's probably a good 6 months out. So I'm not going to sweat that too much until probably January 1st, make a resolution or 2, and then engage in some shape or form.
Well, that's a great line of travel. I'm jealous, and I suspect you might have a few golf rounds in your future as well.
Yeah, maybe I'll get better. You've seen me play that the bar is pretty low, so need to make it a little bit higher.
Well, for me, golf is all about just having a good time out there, and I know we've always done that. So I think that's what matters most.
Absolutely.
All right, Mike. Well, this was a great discussion. I really enjoyed it, and I really appreciate you coming on the podcast to chat with me about pretty much anything and everything across the markets and some of the highlights from your career. So thanks again.
Thanks for having me, Zach. It's been a real pleasure.
All right, and thank you all for tuning in. We will catch you next time on No More Risk Better.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.